Hello and welcome to Sectors Up Close. I'm Ramzan Karamali. Today we're looking at the US defence sector and my guest is Randy Watts, Senior Portfolio Manager for O'Neill Global Advisors. This sector's biggest customer is the US government. It recently increased its defence budget for 2024 to $826 billion. Since Russia launched its defence into Ukraine last year, many investors have turned to the defence industry for investment gains. The war has also seen NATO strengthen and expand. Russia's neighbour Finland joined, and Sweden looks likely to do the same. Just last month, NATO's European members and Canada announced that they were increasing defence expenditure by over 8%. As well as the war in Ukraine, escalating tensions between China and the West have also made the sector attractive to investors. So unsurprisingly, the S&P Aerospace and Defence Select Index is higher this year, but not by as much as the main index. To help us explain why that is and more analysis of the sector, I'm joined by Randy Watts of O'Neill Global Advisors. Randy, thanks so much for joining us. Well, let's start with that thought. Why are these stocks underperforming so badly at the moment?
I think earlier in the year, investors were more optimistic about a soft landing for the U.S. economy, and they really shifted to more aggressive stocks and also stocks that would benefit from a better macro environment. I actually think right now is a very good time to be looking at the U.S. defense sector, because I think as global macro slows and there's some question about how strong the U.S. economy is going to grow from here, I think investors might be attracted to the kind of stable growth that defense and aerospace stocks offer in the U.S. market. These are companies that have high revenue visibility and expanding backlogs.
One of the largest, if not the largest, defence contractor in the whole world is Lockheed Martin. Its share price is actually down this year. What's going on there?
A lot of the larger defense stocks in the U.S. have suffered from margin pressures. Those margin pressures have really been driven by two factors. One is that labor costs are up and also labor turnover is up. It's very hard in the current environment to really keep skilled workers, and companies are having to pay more. And then the second is that there have been some supply chain disruptions. Lockheed Martin, right now, they sell the F-35, which is the fifth generation US fighter jet, and they're starting to develop the sixth generation right now. Many of the US allies are increasing their defense budgets, and one of the places they're spending that money is in aerospace.
How damaging to this sector in particular would a future US recession actually be, though?
It actually probably would not be that damaging. People are worried about budgetary constraints in the US, but I think what's been going on overseas with the Ukraine and Russia and also with China means that defense spending is likely to stay high in the US and the rest of the Western world. So I think these stocks can benefit in a slowing economy because, again, they offer investors really a stable place to get growth.
We all know about supply chain issues affecting many sectors around the world, but this one in particular has been quite hard hit, hasn't it?
It has been. There's been parts issues, there's been cost issues with supplies, and like I mentioned earlier, labor. But I do think as the U.S. economy slows, some of that is going to dissipate. And so I do think it's an attractive time to be looking at the names.
And within this sector, which ones do you favour and which ones are you less keen on?
I should mention that O'Neill Global Advisors is active in these stocks. We do like Lockheed Martin here. The stock, I think, technically is really at a support level, and they actually had a pretty good quarter in terms of revenues and an expanding backlog. In the small and mid-cap space, we like a company called Curtiss-Wright, which makes precision parts for aerospace, both commercial and defense. And we also like a company called Howmet Aerospace. They do enhanced metal products for aerospace, both defense and commercial, and they're really seeing an expansion in demand. So as commercial aerospace picks up, but more importantly, as defense spending continues, these companies are seeing rising backlogs and more earnings, and we think the market is going to rotate back towards them.
Randy Watts from O'Neill Global Advisors, many thanks for that. And that is your roundup of the defense.
I actually don't think it would make much of a difference. Sadly, I think one of the things both political parties in the U.S. agree upon is that the world has become a more dangerous place post-COVID. The Russian invasion into Ukraine, as well as Russia getting tighter with China, is really a discomforting fact for the United States government. And so I think defense spending is going to stay actually quite strong. I think it should average about a 3% increase over the next several years through 2027. Also, in the short run, there is some restocking going on defense consumables in the U.S. to replace some of the supplies that the U.S. has actually shipped and given to the Ukraine.
Randy Watts from O'Neill Global Advisors, many thanks for that analysis. And that is your roundup of the defence sector. I'm Ramzan Karmali, and this is Reuters.